All right. Hey, everyone. It's the R. Sean. Welcome back to another edition of the Financial Transactions of the Future Economy. I'm joined with my regular co-host, Dolly Cranstor. And today we have special guest, Joel Block. We're going to be talking about capital raising, what we're seeing now, what the future holds. Those of you who know us know that Dolly and I have financial backgrounds. Like, I'm an attorney. Dolly and I are both CPAs. Joel's a CPA as well. He'll be joining us here in a second. And Dolly also has a background as a valuation analyst and as a fraud examiner. And we are always bringing you the cutting edge technology for what's happening in the future. So drop us a comment. Let us know what you're seeing out there, folks. Don't forget, we got a comment contest. Best comment of the week gets invited on the show. And with that, welcome, Joel. Thanks for joining us today.
Hey, guys. How are you?
Hey, thanks for being on, Joe.
So we got 3 CPAs. Is that what y'all said?
That's what we said. Yeah, it's a room.
If I was a listener, I'd probably be tuning out about now.
Exactly. We all try to be a little different than the stereotypical CPA, so I hope our listeners are used to us now.
Well, none of us practice, though, do we?
Dolly, some. Dolly does accounting work.
Yeah, well, I do it. I'm a CFO of a public company, so in that way, I practice.
So you're signing docs and stuff.
Mm-hmm.
Yeah,
that's the worst part of the job is signing documents.
Mm-hmm. Yeah, I try to get the CEO to sign them mostly, but
he waits for you to sign first.
Right.
Usually. So Joel, you've been in the capital raising world for a while now.
Yeah, I have. I run a fund, and I've been in the real estate syndication, venture capital businesses for 30 years. I mean, that's pretty much what I've done most of my career. I got started early at Price Waterhouse and left after a couple of years, and accounting wasn't my thing. So I went in, and one of the clients that I had was a big real estate syndicator, which put together group investments. And I thought, God, this is cool. I want to do the same thing. So that's where I've been for the last 30 years. And I've raised a fair amount of money in my career. And I work with a lot of, smaller entrepreneurial companies in the venture business. So that's what I do.
Yeah. And so what are you seeing in the market? And you also host an event, right? You have an event of
twice a year. We work with real estate investors. Not, investors are either passive or they're active. So when we talk about investors, we're talking about active people, people who are, actually buying real estate, fixing, flipping, kind of like you see a lot of those guys on TV. What they don't tell you is where the money comes from. They never tell you where that happens. And a lot of those guys have come to our program because we're probably the nation's foremost guys in building funds and syndications and helping people to structure financial transactions. Look, the bottom line is that you start how you start, but ultimately you want to do it the way Wall Street does it because they're very, very good at it. They make a lot of money. They know exactly what they're doing. So I help guys that are really good at the real estate or venture or film or whatever kind of deals they're doing, structure the money the way Wall Street structures it and provide them with some insight. In fact, I just got back from Vegas. We just spent a week, showing a room full of 50 people how this all works.
Yep. Yeah, I know you have that great event, and there's definitely their own language. This morning I was just reviewing documents from a client who had a VC investment. Now things aren't going quite as well as maybe people had hoped, and digging through the language, it's all structured a certain way, and you got to know how to speak that magic language in Wall Street.
Yep.
So what are you seeing out there in the fundraising world? We talked a little bit offline as we were emailing back and forth. What are you seeing right now? What's happening?
Well, let's talk first what it's been like for 80 years because what people need to understand, they kind of need to understand the history of where this came from in order to really appreciate where we are now. In the 1920s, there were all sorts of hoodlums and gangsters running around town selling widows and orphans deals. They'd say, listen, give me $25 and in 2 weeks, I got the special deal. I'm going to give you $500 back. And people would give them their money, and then those guys would run off to the next town and do the same thing again. And, of course, they didn't have social media, so when they were gone, they were gone. It just was over. Stockbrokers, it was the roaring 20s, and it wasn't just roaring because of dancing. It was roaring. The markets were roaring. Everything was roaring. It was an awesome time in our economy. And it all collapsed in 1929 with the crash and the whole thing that happened there. So after that, the government convenes a session And in 1933, the Securities and Exchange Commission was born. And the purpose of that was really what they basically said was, listen, if you're going to raise money from regular people in this United States of America, then you need to tell us what you're doing so we can keep an eye on it. Because it's not so much that the government really cares that people lose money. I mean, I hate to be cynical here, but they just don't want to put people on welfare. They only care when it becomes their problem, which is when you don't have any money and you have to come and ask for help.
Well, as an aside, Dolly and I have been covering the lotto tickets versus the regulation of investments. We find it to be an interesting dynamic.
Yeah, listen, I mean, in a certain way, lottery it's so ridiculous that the thing about investments is that people expect to get their money back plus more. Lottery tickets, they don't expect to get anything. It's a lark. But anyway, so the government sets up all these rules, and the entrepreneurs of the day in the early 1930s, 32, 33, 34, they run to Congress and they said, listen, this is a terrible idea. We can't have you look at every single piece of paper for every single dollar that wants to get raised. Yeah. What it's going to do, it's going to stifle innovation. It's going to slow entrepreneurship. It's going to be bad for the economy. It's hard to imagine that 100 years ago, the same logic, the same issues that we have now existed then. It's just, it's the same world, different technology and a few things, but the people are all the same. And so the government basically looked at them and said, you know what, you're probably right. If you're dealing with well-heeled people, and they created a standard called the accredited investor standard. If you're accredited, then we don't need to supervise. If you have the money to hire your own attorney, your own accountant, your own people, then we don't need to supervise because you're not going to go on welfare and it's not going to be our problem. And now that standard's 200,000, 300,000 if you're married. So 200,000.
That's annual income, folks. That number's the annual income.
Yeah, annual income or $1 million net worth, excluding your home, for that. So, and those numbers change over time. It changed, 5 or 10 years ago, and every so often they relook at those. But that's kind of what it is. So in my world, we deal with the accredited people more than the non-accrediteds.
Yeah, that's what most people.
Real quick, Joel, just to clarify, can you have either the million without the house or the income, or do you have to have both?
It's either. It's either one. Okay. So you have to meet one of the two standards. Yeah. And if you do, then you're an accredited investor.
Yeah. And there's actually a couple of side doors as well. You can be on a board of directors or do a few.
Yeah, well, yeah, there are a couple of ways that you can, just kind of be listen. There are many exceptions, which all lawyers have exceptions, and but the main standard are those two standards: 200,000 single, 300,000 married for income, or $1 million net worth, excluding your personal residence. So, that's a really important thing, and there you go.
And most investments, like you say, Joel, because the way these rules work, almost everybody targets their investments and accepts investments from these higher net worth or higher income individuals. Well,
yeah, and think about why. First of all, that's who has the money, are the people that have these investments. Now, what you create is a thing called a private placement, and the word place in stock market language means to sell. So it's the way you privately sell securities. And securities are any kind of a financial instrument where another person is in control of making it work.
Yeah.
So if you buy something in the stock market and a board of directors is responsible for making it work, you bought a security. If you buy an interest in real estate and other people are doing it, so if you're passive and they're active, then you probably bought a security. And so these security rules are very complicated. The government doesn't really like regular people fooling around with this stuff because there's some risk. And one of the things people ask me when they come to my symposium, one of the first questions is, have people ever heard of this before? Is this popular? And here's something, guys, that's going to be shocking. You probably never heard this. But, the private securities market, which is, the sale of these private securities where I operate, is bigger than the entire United States stock market. Bigger. Because guess what assets are held in private placement, in private securities? Well,
real estate, obviously, right? That's
almost all the real estate in the whole country is held in these private security investments. Yep. So most of the commercial buildings, the industrial buildings, all the skyscrapers, all these giant properties are held in private securities.
Yeah, and probably number two behind that is all the family money, the family fund.
Well, the family money, listen, what they do, they spread their money across these private investments.
Yep.
So it's either LLCs or venture capital or They're called alternatives. Alternative investments are everything that's not a stock, bond, or mutual fund. Those are the main things on the stock market: stocks, bonds, and mutual funds. Which, by the way, we're called alternatives. Why are we alternatives? Because we typically don't pay commissions to Wall Street the way that stocks, bonds, and mutual funds do. So we're alternatives, meaning that they don't like us that much. So
there's a whole structure
funds,
of that we've been talking about, Dolly and I, with the blockchain and trying to eliminate some of that friction.
Well, that's I think a little bit of background kind of helps people understand this. The blockchain is going to make a big difference, and Wall Street, they're losing their fence. I mean, they've got a big fence around all the money in the country, and that fence is coming down. And it started in 2012 and 13 with the development of the crowdfunding rules.
Right.
So we'll talk about that here this morning.
We think that's part of the tension we're seeing right now is that because the walls are coming down, there's a lot of like, oh, don't change the rules, don't change the rules.
Mm-hmm. And we constantly refer to those as moats.
Well, yeah, I mean, listen, the fence or the moat that Wall Street's always had, over all that money is really breaking down. And it's making it possible for other companies. For example, let's take a look at venture capitalists. I mean, what do venture capital guys do? I mean, I spent years in the venture capital business, and they basically finance innovation. When young companies have an innovative idea, they finance it. That's basically what it's called, innovation finance. And so venture capital guys put that money up, and they've always supplied that money. That's what the venture capitalists do. But all of a sudden, when an entrepreneur can go to the marketplace and do a Kickstarter or do some of these other kinds of techniques that bring money in, and all of a sudden the venture capitalists are less necessary, that bothers them. I mean, it's a real problem for them, because the truth is that they're sort of intermediaries. In a certain way, they're in between investors and the companies. Yeah,
well, I mean, the rules, because of some of these private placement rules and other things, they get kind of first grab at a lot of these things, and everybody comes to them.
Here's what happens. There's a lot of reasons why these rules changed in 2012. So I started by saying what the rules were in 1933 when it first started and where it came from. But the rules weren't working, and they had to change the rules starting in 2012. And the reason was that after the 2007-8 crash and all the different problems, entrepreneurial companies couldn't get a hold of any money. The banks weren't lending. They weren't lending to anybody, especially little companies. Yeah. And worse than that is we had all these people with trillions of dollars of IRA money and other kinds of savings accounts that were getting a quarter point, half point interest. And so the government said, listen, we have to find a way to let people with interest sitting in a bank connect with people who are starting companies and need to borrow money. And maybe we need to put these people together and let them work together some way. The second thing that was happening, it was kind of a legal thing, and that was that, if Sean, I invited you into my deal, let's say I run a fund, and I said, hey, Sean, you interested in my deal? And you said, yeah, I'm interested in taking a look. I send you the materials, and you say, okay, I'm interested, I'd like to invest. I said, perfect. And then you say, hey, would you mind if I gave you a referral? I got a couple friends that might be interested in this too. I said, well, gee, I'd love a referral. That's the highest honor. It's the best way you can say thank you, right? So you go, yeah, I'll tell you what, I'm going to send it out to a couple of my friends. I'll do it tomorrow. And accidentally, the guy runs out of time, and he just instead posts it on Facebook, Twitter, LinkedIn, wherever he puts it. And now there's been a general solicitation or an advertisement about my offering. So now my offering is contaminated. And that is a huge problem when that happens. So when my offering gets contaminated, all of a sudden I can't offer the securities for sale anymore. And that wasn't my fault. And so the government said, maybe we need to remove these general solicitation rules. Maybe it doesn't matter who sees it. Maybe what matters is who invests, and we need to measure who's investing, not who's looking. And so for all those reasons, the government changed the rules, and the rules are working pretty well. I mean, they really are working pretty well. So now if you're seeing a lot of advertisements for investments in real estate, investments in venture companies, investments in this or that, that's why. It's because they changed the rules in 2013. Well, they changed them in 12, but implemented them in 13. And they've been adopting different levels of crowdfunding rules ever since.
Now, on that crowdfunding, are you specifically talking about the venture capital piece, or more on back to the LPs and the people that are raising the PPAs?
There's three kinds of crowdfunding. So you have donation crowdfunding, which is grandma died, there's not enough money for a funeral. Okay, so people donate. Not a lot different than giving money to the church, except for no tax deduction for you. Okay, that's first thing. Second kind is called donation and reward. So you make a donation, and if it's successful, you get a reward. That'd be Kickstarter and Indiegogo. The third kind is investment crowdfunding. That's where we operate. So investment crowdfunding, it doesn't matter if you're doing venture capital, real estate, it doesn't make any difference. The rules are the same regardless of the asset. So, it's very simple. Now, there are a couple of some advanced things that I would like to get into now. Sometime today is talk about these Reg A Plus offerings and some other stuff that's happening that's very, very smooth. So people who are raising money have a lot more options than they've ever had before. But,
right.
But just kind of as an overview, that's where we're at.
So real quick though, before we move on, some of the pain points in the current system, like there's liquidity issues. You've got to wait for a certain period of time. There's a delay in the responsiveness of how your assets are doing. I think they call them NAV statements. Could you talk a little bit about those pressure points and maybe what's pressuring this change?
Well, listen, all investments have certain kinds of problems. Probably the biggest risk of a private placement is illiquidity. The fact that you can't turn it into cash. In the stock market, if you're not happy, if you need cash, you got a problem, whatever it is, you take your securities to your broker sells them and you get cash. Now you may not get the price you want, but you can get your cash. You can get it immediately if you want to. In a private placement, somebody calls and says, hey, listen, Joel, I need to get the money back. Well, there's no way to get it back. I mean, there's no market. There's no secondary market. In fact, that's the whole definition of what these private placements are, is that you're not allowed to have a secondary market. You're not allowed to resell these securities because the government wants to make sure that well-heeled people are holding on to them. You buy them, you hold them for a long time. The government wants us to save money. They want us to take care of ourselves. They don't have the money or the capability of taking care of every citizen. They can barely take care of hardly any citizens, and let alone, all of us. So they want to give us ways to invest our money and be smart. But they also don't want us to be tricked into dumb things that are going to be bad or go south in some other way. So the government is very clear that they want us to be smart about how we handle these things. So illiquidity is the biggest problem. Communication is totally on the asset manager. Some are better than others, and they'll send out statements. In the real estate world, it's not so much net asset value like you referred to before. That really kind of is more in the security side, kind of in the mutual fund business. They kind of net out all the stuff. Much harder to value real estate because real estate just doesn't get valued every single day the way the stock market does. So some of those issues, but illiquidity is the big problem that people need to think about. If you're going to need the money in the next 5 years, this is not the right place for you to go.
Got it. All right, folks. Yeah, just so you understand, the big pain point in private equity deals and these alternative financings specifically relates to your capital's kind of tied up for, could be 5 to 7 years, but your returns may do very well. So anyway, Sean, you want to pick up?
Yeah, sure. Sorry about that. A little minor technical glitch here. Windows decided it was a good time to do an update. It wasn't a great time for me, great time for Windows. So very interesting about the liquidity and the fact that, I guess that's part of the disclosure part of this, Joel, and I don't know if you, Dolly, had a chance to visit on that. But
well, listen, here's what happens is in order to come into these deals, you have to review a private placement document, and that largely includes all sorts of disclosures about risks. Here's all the things that could go wrong. There could be a meteor could hit the building. Maybe you don't have enough insurance. We could lose our investment. All these different things could go wrong. We could find dangerous chemicals. Interest rates could change. Tax laws could change. All sorts of things could change, all of which could be bad for us. And if that happens, then we could all lose our money, and that's how it goes.
And it's usually
but we're talking about dealing with big boys and girls who can withstand nobody wants to lose, but we deal with people that can.
Yep. And real quick, before we move on, I always recommend people that are reading a PPM, always look for that dilution page. There's actually, in every one of these documents, it shows what you invested at that rate, and then it kind of shows what your percentage ownership after you consider ownerships of the founders. So very important page. A lot of times you'll see you're diluted in some of these big like tech deals or something. You may be diluted 99% in one shot.
Yeah. Now that's a different. Here's the thing. If a company is going to go public, that is very important to understand. There's how much you're diluted, but also the shares should continue to be worth more over time. In a real estate transaction where there really is just share of profit, getting diluted is not the worst thing, because what happens is if you own 1%, let's say that you own 1% now, and then they raise twice as much money. Now you own 0.5%. You're sort of the same off. So if you have 0.5% with twice as much money, you're really about the same. It's really not the end of the world. But in a venture transaction where you go public, it makes a big difference.
Yeah. And you said you've been seeing a lot in the so there's a lot of exemptions available, and I think, Joel, you said you've been seeing a lot in the Reg A plus space, right? So
Reg A plus seems to be, and I'll explain what this is, but it seems to be the one part. Well, there's two things in crowdfunding, those rules from 2012, the Jobs Act of 2012, that have really stuck very well. Number one is being able to advertise or generally solicit, very significant. Yeah. In my business, it's always been a country club kind of business. It's very quiet. Nobody really talks about it much because it's been illegal to talk about deals. It's illegal. You're not allowed to do that. And if you do, then you contaminate your offering, and then you lose your exemptions, and all sorts of other things go wrong. So it's no wonder that many people have been excluded from these opportunities, because it's a country club deal. You talk to some guys, and that's it. You can't go public about it. But with these new rules, lots of new people can come into the table. Lots of people have plenty of money to play ball, and they just haven't had the ability to before. So now they're coming in, and that's a big part of it. That's something that's very significant. The second thing that's been very good about these new crowdfunding rules is this thing called Reg A plus. And Reg A plus is what is known as a mini public offering. So to do a public offering is millions of dollars. You have to file registration statements with the Securities and Exchange Commission federally, plus probably with all 50 states. There's just tons and tons of legal work that has to be done, audit work. I mean, there's all kinds of things that have to happen to make a company go public, and for it to stay public, by the way.
Yeah.
And there's lots of reasons why companies do that. But a lot of companies who wouldn't mind to be able to access the public markets and be able to have some liquidity of their shares. And remember, I said that when you do a private placement, you're kind of stuck in the deal. But what if you could do a small raise, and small means under 50 million. If you could do a smaller raise and give your investors some liquidity by tapping into one of the smaller exchanges.
Right.
If you can do that and keep the cost down, then that will be a home run. And that's what Reg A plus is. Now, Reg A plus, it still costs $1 million to do it. You can't get away with a cheap deal. It probably costs $500,000 up front for some legal advisory and some other kinds of things, plus the marketing, because you got to let people know you're selling your shares. But these offerings have been done for 5 or 6% of the total proceeds, not all of which has to be paid up front. Some is paid on the back, so it's not cash flow impossible. But a lot of these deals have been done, and now people have liquidity, and these deals are working. So the Reg A plus deals are really working pretty well.
Yeah, and when we saw them come out, and when we saw initially that on the upper ends of the bands, right? So there's a $20 million band, and there's a $50 million band within Reg A.
Right. Nobody's doing the tier 1 $20 million band, and that's because those require merit review by the states.
Yep. So
if you do a tier 2, you're exempt from state merit review, and that saves a lot of money. It's just better. So nobody's doing those tier 1s. They're all doing the 50 million tier 2s, regardless of how much they're raising. So even if they're raising $5 million, they're still using the tier 2 rules because they're just better, easier rules to get around the federal state requirements.
Would it still cost $1 million to just raise $5 million under a Reg A plus?
Yeah, you have to have an attorney, you have to have some advisory assistance, and then you're going to have to do some advertising. So you got to put advertising out, let's say on Instagram or Facebook or some other places. I mean, put it like this: here are the things that work. I think that these work best for affinity kind of offerings, things where people really are attracted to it. So if you're raising money to build something very unusual, like a Planet Hollywood hotel, like a really cool brand, people are going to say, gee, I want to be part of that. And so regular consumers would be attracted to it. If you want to buy an apartment building forget about it. A Reg A Plus isn't going to work because nobody cares enough to get excited about that. So you really have to pick your battle carefully, and you have to do the right kind of an offering. But if you do the right kind of offering, people on the internet will say, gee, I'd like to be part of that kind of deal. And then they come in and money's coming. So it's a marketing kind of deal. It's a selling kind of deal. You have to think about these things in the right way. But if you do, they work very well.
If you're raising 50 million, Joel, and you only get to the 10 million mark, how much time do you have before that offering closes or you have to renew it?
You know, in a private placement, you set the timing for your rounds. So we typically set our timing, give or take, around a year. So the round's going to close, the funding round is going to close as soon as you hit your number or when the clock strikes the magic number, whatever the date is that you set. In a Reg A Plus, the clock is a little worse because now you have certain timings that you got to get to market. The government has to look at your documents. There's a certain amount of time that can pass before they have to look at them again. They become stale. So the clock is much tougher in a Reg A Plus than in a private placement where there's not a lot of oversight or regulation.
Yeah, got it.
Joel, what do you see coming down the pipe? What do you think's next?
What's really become popular are these ICO, these initial coin offerings. A lot of the crypto stuff, it's all based on blockchain. I'm sure you guys are talking about this. Yeah. Here's what everybody needs to understand is that the blockchain is real. The blockchain is a cloud technology where, it's kind of the next level. So Dropbox, we all have Dropbox and OneBox and Google Cloud or all these different services, whatever they are. This is really a security measure that allows us to be more comfortable with these kinds of technologies. And the blockchain makes it possible for voting in the future to actually happen electronically and in the cloud, because we can actually trust it where it can't be stolen, because they take the document and just like you go to a notary's office, it gets notarized and then distributed to 1,000 places or 1 million places all over the world, all over the internet. And so it can't really be changed in a reasonable way. So that's what all this, that's the backbone of what this is built on. Blockchain is not money. Blockchain is a technology. On top of that technology, now companies are building these Bitcoins and these different kinds of Ethereum and these different financial technologies. So they're real, but I don't know how many of them we need. I mean, there are hundreds and hundreds of them. There's going to be 1, 2, or 3 that survive. I don't know that we need a lot. I will tell you, governments around the world are terrified of it. They don't like it because it's hard to tax. It's hard to track. I mean, let me put it like this. Maybe you guys go to some of these CPA meetings. I go once in a while, and I heard an IRS person recently talk, and the guy said, if you put your phone on the table and say, look, everything you need is in my phone, the guy's going to pick it up and say, is this an Apple or is this an Android? Right. I mean, they said we're 20 years behind schedule. We can't pull a transaction out of your phone. We don't know what to do. Yeah. So if you think that that's a problem, we're pretty far along now, 20 years into a lot of the cloud computing and everything. Yeah. They're terrified of the Bitcoin and the other kinds of financial currency because they can't tax it, they can't collect it, they can't control it, and there's been a huge amount of fraud. I mean, it's ripe for these fraudsters and these other bad guys. So
it's very disruptive. It reminds me, I do some work in the automotive industry. I'm working on a couple of books over there, and the early days of the auto industry, U.S. had I think one of my co-authors said back in the early 1900s there were 150 auto manufacturers in the state of Indiana, right? I mean, so that's where we were 120 years ago with automotive technology. That's kind of where we are with Bitcoin and blockchain.
Well, except that a car is a product, Bitcoin is a currency. And
hold on, Joel. Hold on, Joel. The SEC says that it's a security. The CFTC says it's a commodity. The UCC says it's money. The Office of the Comptroller, UCC says it's not money. The Office of the Comptroller of Currency says it is money, right? So our regulators don't even know what it is. They don't know what
listen, that is exactly what the problem is. The government they're terrified. And I guarantee that the international monetary community, they're even more concerned because they don't know what to do with it. Yeah. And by the way, it can be a currency, it can be a security, it can be more than one thing. because things have character and these different characters.
It's just different laws, and the laws don't cooperate with each other, right? So
right, because we don't have laws for these things yet.
Right.
I mean, this is the really the cutting edge of where things are going.
The IRS says it's not money, but the comptroller of currency says it is money, right? The IRS says it's property. So they're going to fight this out, and the laws need to be updated.
Yeah.
So that's one of the things.
Well, listen, the government, the IRS doesn't care if it's really money or not. What they care about is if there's profit being made on those transactions, they want a piece of the action. And they're having a hard time keeping an eye on it.
It is convenient that the property classification leads to more disclosure to the IRS and more taxation. Because there was some up till 2014, they didn't know whether it was going to be property or money, but the IRS came out and said it's property, and we'll treat it that way, which leads to more disclosure, more.
Yep.
Hey, Joel, can you combine a Series A or a Series A Reg A Plus with an ICO so it's in full compliance with the SEC and these bodies, but still as an ICO?
You know, you're starting to get over my level here now, you know, when you start getting technical. But I'll tell you what, there are these Reg A Plus offerings where the currency that comes in is not green cash, but rather it's Bitcoin or it's some kind of other financial currency. So they are combining them. I don't exactly know how to answer the particular question that you're asking, but the currencies are being used to fund these securities transactions.
Excellent. So a new class of wealthy people that got rich during the crypto boom can now participate in the other non-traditional assets.
It works in that direction, and there are people who got rich doing one thing who are going to end up not rich after this other thing.
Yeah, that's so true.
You know what they say, a fool and his money are soon parted. They were lucky enough to get together in the first place, right?
Yeah, that's fantastic.
One final question for you, Joel. What do you think about international competition and the changing of the markets?
Which markets?
Just the financial markets, financings internationally. Of course, you know, blockchain and crypto are obviously a very international.
Yeah.
Right. National borders mean nothing typically in there, except when they start.
Well, let's take a look at in 2007 when the banks started crashing and they were having all these problems, and there was the bailout in 2008, 9, 10. You know, one of the things that I started hearing was that certain banks are too big to fail. And my initial reaction was, if you're too big to fail, you're too big to be in business. And that was kind of where it is. But as I really started to think and research and understand this, in order to compete in the global marketplace, our United States banks have to really be big. They have to be able to provide horsepower that most of us cannot understand. Because treasury management, currency management, the kinds of things that happen in public companies is so complex. I mean, when you stop and think about what consumers do, that's very simple. But international transactions where you're doing lending, you're doing conversions, you're doing all kinds of things. Banks have a giant responsibility globally that is very significant. And for all of those reasons, banks need to have really big footprints. That being said, the blockchain is kind of eliminating the need for a lot of things that we take for granted. When you talked about the moat around Wall Street or around the venture capital world, it's kind of dissolving everywhere, and we're kind of blending. Now, it's funny that people are having such a hard time getting along because the world is actually getting more unified. The people somehow are having a little more trouble getting along, and I wish we could do better at that. As well, maybe only in our country, maybe other countries too. I don't know.
Well, Dolly and I are starting to question whether with the coming blockchain and the digital relocation, whether people are going to start migrating to align with people that want to have the same type of economy that they do. We think that may be a longer term trend.
Well, listen, people are welcome to organize or reorganize any way they like. That's kind of a hard thing because we're kind of set up in one way, and no reason to think that it couldn't happen.
Yeah, well, we think that pressure might be coming. We see a small version of that happening right now, where people are deciding that they want to change their country of allegiance, and we think we may see more of that here in the future.
Yeah.
So, folks, thanks for joining us, Joel. Thank you for joining us, of course. Our goal is to wake people up, get them thinking about the future transactions, what's happening on. We got big change coming with blockchain, et cetera. We always ask our audience members like, comment, share, because it lets more people know about what's going on out there in the world and these important things. Joel, how do people get a hold of you? Maybe somebody's interested in maybe coming to one of your seminars in the future.
Probably the best thing is go to joelblock.com. Listen, I speak to audiences. I do programs in different places and advise companies on capital raises. And listen, I've spent my lifetime in the hedge fund and venture capital world running funds and venture capital deals. So joelblock.com is probably the best way. And then there's all my contact information. Everything is on that website. Bullseye Capital is my company, and it's there too. So you can find everything all in one place.
Fantastic speaker and keynoter. I've got to see Joel present before, and he does a great job. So
thank you.
Really appreciate it. So cool. Dolly, you have a quote for us?
Yeah, I do, Sean. It's a two for today, super short. First one, try not to become a man of success, but rather try to become a man of value. So do your best to increase value. Success and the moats around success and the scorecard of money may be changing. The second one is, I learned the value of hard work by working hard. I think we all know where that comes from. And if we all work hard and continue this journey together, I think we can make major progress.
Wonderful. Folks, if you need more information, futuredoneright.com. You'll see our videos there. Joel, thank you for joining us again. And
guys, thank you very much. Pleasure to be with you.
Thank you, Joel. This is amazing.
Audience members, thanks for doing the hard work to make your future better. We appreciate you being here.